Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cantor Equity Partners IV Inc. Annual Report. Cantor Equity Partners IV Inc. is a business entity that specializes in facilitating mergers and acquisitions between various companies. The company's primary objective is to effectuate a merger, share exchange, asset acquisition, or similar business combination with one or more businesses. The scope of Cantor Equity Partners IV Inc.'s services includes providing support for reorganization and share purchase transactions. This suggests that the company offers a comprehensive range of services aimed at facilitating strategic partnerships and consolidations between businesses. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The net income of the company underwent a significant transformation between 2024 and 2025. In 2024, the company reported a net loss of $7,000, but in 2025, it recorded a substantial net income of $6,132,000. This drastic change can be attributed to the interest income earned on investments held in the trust account. The profit margins also underwent a remarkable shift from a negative 100% in 2024 to an impressive 99.9% in 2025. However, it is essential to note that these changes were likely influenced by various factors such as accounting estimates and redemption values, as well as the recognition of accretion from initial book value to redemption amount value of redeemable class ordinary shares. The increase in net income can be directly linked to the interest income generated on investments held in the trust account. This influx of revenue significantly contributed to the company's financial turnaround. On the other hand, the profit margins were affected by changes in accounting estimates and redemption values, which had a profound impact on the company's overall profitability. But the company's debt level has undergone a notable increase. Initially, the debt was at $0 as of December 31, 2024. However, by December 31, 2025, it had risen to $31,000 due to the sponsor loan. Furthermore, this loan has the potential to reach up to $1,750,000 with no interest attached. This significant increase in debt level is a key development for the company. In terms of interest expenses, there are some interesting observations. The company does not pay any interest on the sponsor loan, which means that it will not incur any interest expenses related to this loan. However, the company does report interest income from investments held in the trust account. This suggests that while the company's debt level has increased, its interest expenses have remained relatively stable due to the absence of interest payments on the sponsor loan. Management's primary focus is on acquiring companies that complement their background and experience. They believe this approach makes them an attractive partner for target businesses, offering options such as creating a liquidity event, providing capital for growth, or strengthening its balance sheet. Despite expecting intense competition from other entities, management is confident in their ability to complete the business combination using various funding methods. Management's strategy revolves around flexibility and adaptability, with the ability to use cash, debt, or equity securities to complete the deal. They also expect costs associated with dissolution to be funded externally, but acknowledge that there may not be sufficient funds for this purpose. The per-share redemption amount upon dissolution is uncertain, potentially ranging from $10.15 to a substantially lower amount due to creditor claims. Management's long-term outlook and strategy are not clearly defined, as they prioritize completing the business combination over providing a detailed vision for the company's future. However, their focus on acquiring complementary companies suggests a desire to build a robust and diversified business portfolio. The company's dividend policy is a notable aspect of its financial strategy. According to the provided information, the company has chosen not to pay dividends to its shareholders. This decision was explicitly stated in the company's documents, specifically on page 24, where it is mentioned that no cash dividends have been paid and none are planned prior to the business combination. This lack of dividend payments suggests that the company is prioritizing other financial objectives, such as investing in growth initiatives or reducing debt. By not distributing profits to shareholders through dividends, the company can retain more capital to fund its operations and pursue strategic opportunities. That concludes the financial summary for Cantor Equity Partners IV Inc. Feel free to comment below, and I will be happy to answer them when possible.